guys are doing good today. I hope you guys are surviving the sell-off, the crash. May it go down in history, the May 10th crash of 2023. Might have to put an option omega for this one. If it's brutal. So, it's not brutal. I hope you guys are doing well. We're going to get started. I'm going to jump straight in because I have another thing I have to do in a little bit. I sucked at time today and I double booked, but this is the more important thing. So we're going to take the time necessary. As always, my name is Troy McNeil, co-founder of Option Omega, and options involve risk, you should know, and they're not suitable for all investors. Everything I'm about to say is backward-looking and not forward-looking. As always, consult with your financial advisor if you have any questions about options. This is not to be construed as financial advice. This is simply entertainment purposes. So I hope you are entertained. Are you not entertained, as Maximus says? Okay. With that being said, I'm going to share my screen. Can you guys see that? Perfect. Okay. So what are we talking about today? What we're talking about today is when vol is sickly. Now, here's a quick question, and this will reveal a lot. And it's okay. Please be honest. This is good. Has anyone ever traded here when VIX is below 20? Mr. K says yes. It's okay if you haven't. Sweet. So you guys have traded a little bit. Previous to 2020, VIX, 20 VIX was very, very high. That the normal vol environment has, over the last 10 years, has been one of under 20 VIX. So there's a couple things I want to say straight away today. One, I don't think vol is anemic right now. I don't think vol is like dead. I have seen vol dead before, and it's a wasteland. It's a dangerous barren wasteland. It is not sick historically. It is weak, very weak compared to the last 3 years that we've seen since COVID and then inflation and all that stuff. So I want to say that straight away. I'm not sitting here saying vol's dead. You know, it's by far it's not dead. A 17 VIX is not dead by any means, but it is low compared to what it has been. So I'm going to show some tests today, and I'm going to give you straight away the caveats of these tests. And there's two main takeaways from these tests that I want you to just know and cherish in your heart forever. Just write them upon your heart. One, we do not have as an exit. We used to. We actually took it out because no one was using it, but maybe we'll put it back in. There is no exit condition in Option Omega for a VIX to exit when the VIX goes above this level. So what I am presuming in all of these tests that you would want to get out when VIX gets back over 20. So VIX is a no-go land. 20 VIX is a no-go land. All these trades, take into account, you do not want to be in these trades when VIX is over 20. Does that make sense? You don't want to do that. These are not above 20 VIX trades. These are low VIX trades. So that's the first caveat. Two, the main takeaway I want you to take away from the takeaway today when I take it to, you see what I'm saying? Takeaway is when vol is low, you want to go farther out. Now, why would I say that? Why would I say that you, as a general rule, want to go farther out in time when vol is low? You can type it all on in if you want. Any guesses? as a general rule, yeah. I mean, VIX could drop 80 or 90% from here, right? But as we've seen even in the last week or two, VIX can drop 80 or 90% from here, but that's going to be a slow drop over time. Versus it 100% could go up 25% tomorrow. I mean, what's it up right now? I haven't even paid attention to the market today. What's it up right now? I imagine it's up a little bit, I suppose. Maybe it's down, maybe it's break even. But, VIX can go 20, 25% up just like that, especially when it's at these levels. So, yes, to a certain degree, Robro, great name, by the way, Robro, it can only go up. It can also go down, but it goes down slowly. It can go up a lot faster than it goes down. 2, so you're not getting paid for IV crush as much as we were 6 months ago or 8 months ago or 3 years ago, certainly. You're not getting paid for IV crush, so you have to take that Greek. You have to do some different things with that Greek at this point. You have to do some different things with Vega. Your theta is affected via charm and some of these second order Greeks by the Vega. Therefore, your time is different. You're not getting, if anybody's been trading 0-day spreads, you might have noticed that as it hasn't moved as much, the ranges get smaller per day. Perhaps you're not getting, your deltas are a little closer in. A 25 delta now is a lot closer in than it was 6 months ago. So your Greeks are affected by this low IV. The low IV is kind of setting a new angle for this. And so therefore your gamma, your shorter term gamma risks, especially for selling premium, is a lot higher in a low IV environment because you're not getting paid. You don't have tools in the toolbox of your Greek toolbox to offset the gamma risks. So the gamma risk becomes a lot more pronounced when IV is low. Does that make sense at all? Good. I require one yes every time, or else I feel like I'm just an idiot. And it gives me times to smoke my cigar, which is good. So with that being said, those are the caveats. In general, you don't want to put any of these on when it's over 20, or at least you'd want to retest them with a different time frame. But 2, you want to think about your trades differently. You want to think about time as your friend in a way that it's not been your friend necessarily the last couple of years. So, or you have to at least think of time differently. So with that being said, I'm going to get into the trades, and we're just going to go through them one by one. Again, these are not my favorite type of trades, but these are the type of trades that I cut my teeth on. I learned option trading in this environment. And in particular, most of these tests are going to be used for the year that you guys probably skip when you're trading or testing, which I do too for the most part, because it's been a different environment. But these tests are mostly going to be based on the year 2017. Was anybody trading in 2017? Congratulations if you're still here. That means that you have survived. And in this game, that is the number one trait to have, is survivability. So let's go through them real quick. 2017 we used because it was a year, if you look, VIX just got annihilated all year. Like a beatdown of all beatdowns that year. And the market largely just went up, but it wasn't like it wasn't like a vol type going up. It was like a slow bleeding crush up. And I'm not saying that this year has the potential for that. But what I am saying is that as we've seen the first 4 months, the reason vol's contracting is that we're just not doing anything. We're just not going anywhere. And so that's our test case for today. So let's go through these tests. So first off, we're just going to start and go down the list. This is a 10-day put spread. Now, straight away, you'll notice I'm going 10 days out. You could test it farther out. This is just for the purposes of it. You could start with 10 days. And what you'll notice about this test, can anybody else see my screen? I'm just talking crazy otherwise. Castle can. Okay. Robo, you might want to jump in and start again. Sorry. I do have poor quality. The cigar shop has poor quality internet. I'm on a hotspot right now. Can you kind of see it? As long as you can kind of see it. Here, this is what I'm going to do just to make it easy. We'll just make it easy. There we go. There's the first test. Look at it on your own screen. And that way you guys can go from there. That's good. I love that feedback. Rather than me look like a freaking idiot. I mean, it's inevitable. I will look like an idiot. But if I can remove some variables of me being an idiot, it'd be good. So that's the first test. So let's walk through it together. The first thing you'll notice is that it's 10 days out. It's a very conservative spread. And this is not my favorite type of test, but it at least, again, Option Omega is an idea generator. So hopefully it gives you some sort of sense of some things to maybe think through. So this is run for the year of 2017. And sorry, I just opened up an extra screen. It's run for the year of 2017. And you'll notice something ridiculous about this test is that it is 100% win rate for a very large data set, which is ridiculous. And again, this is why I say you definitely don't want to put this on when VIX is over 20. That would be my metric. If you're like, well, there's no stop loss on this. There's no like exit condition other than profit. I would say yes, and my profit condition or exit condition would be a VIX above 20. A VIX above 20, you want to get out. But otherwise, this is pretty ridiculous, right? I mean, that's a pretty damn smooth graph. I've got the Punisher on. I've got some slippage, stuff like that. But again, this is wild to me. 248 winners, 248 trades. That's bonkers to me. And again, this is a 12-month period. The market, I'm cherry picking a little bit, but I'm not as interested in what the market did. I'm interested in what the vol did during that year, where vol just continued to get wrecked. That's what I'm looking at. Does that make sense? Any questions about that one? So what's the takeaway of that one? Maybe, I know 0 day is 0 day, and 0 day is why a lot of us are here. But, there's other expirations. Maybe that's the takeaway for it. Next test. We go to my old faithful. This is one of my favorite tests through time, but we look at it here just for 2017. This is a double calendar. Let me know when you guys have it on your screens. You guys got it? Sweet. Okay. So I love double calendars. They're my babies. They're my little option babies. I don't know who the mother is, but they are my option babies. This is a 9/23 double calendar. And honestly, this was kind of my default calendar for the first 3 years of my trading career. I never would have thought. If you look at a textbook of like double calendars that's written pre-COVID, this would kind of be the standard. Like 1-2 DTE calendars is crazy. Like that was one thing. The Option Omega in my mind was like really cool to be able to find that, because 1-2 or even a 0-1. Your graph is all messed up on your brokerage. Like it probably doesn't look like a winner at all. It looks like you're negative theta and all that stuff. This one, you actually are positive theta, even theoretically from the graph. And, it's got a pretty good win rate. The drawdown's not terrible. And, 100% ROI over the year is, not a bad trade at all, right? But again, the key of this is you're using a 28 delta put and a 29 delta call. Why the different deltas? Well, the goal is you kind of want to be about a -1 delta, close to as delta neutral as you can. And so that differential of delta will kind of get you there to like maybe being short 1 delta per contract, per spread. And that's what you want. And the profit target, again, is 20%. And again, I would get out at a VIX of 20. What does this do for you? I really like this trade. This is one of my favorite trades because what it gives you, double calendar, is especially in a low VIX environment, you're positive theta. So you're collecting theta to be able to sit there a little bit, especially for this 20% rate. You might be able to get 20% without it doing anything because you have time for it to breathe a little bit. You have your positive vega, right? And so those being so farther out, the expirations being like 14 days apart, gives you a lot of vega. And so, and your gamma risk is pretty low on this. Again, being that far out. Any questions about that one? Those who just jumped in, you can look in the chat and see the link to the one I just shared. It's a 923 double calendar. Any questions about that, calendars? Especially with calendars, I want to encourage you in a low VIX environment to get out of the mindset of it being within a week. Are there winning trades? 100%. But again, this is kind of a mind shift segment. You want to think about, you want options to be working for you. You don't want to be gambling with them to where you don't have the edge going in. So we're trying to I'm going to make up a word here, equilibrate. It's so stupid. Equilibrate your chances by returning the Greeks in your favor in a low VIX. And so that's what we do when we move out in time. We're returning the Greeks to our favor. Any questions? Oh man, I did it. Thank you, bro. That's a real word. I did it. Okay. Hey, I'm knocking off reasons I'm an idiot one by one today. We'll keep going. Please put your questions in if you have any. Okay, so these are going to be, I'm going to show these, I'll do those last. Let's go to the Jade Lizard. The old Jade Lizard. That's the goal, AA 2NE300. Stack the things in your favor. Especially probabilities, especially trades like we're doing where the mechanical, you want probabilities. And so as environments change, sometimes you gotta change your style to restack the probabilities. If you're at the craps table, that's a different ball game than the roulette table. So you gotta figure out where you're playing. All right, you guys got that link, the one I just sent? Okay, cool. So, have you guys ever traded a Jade Lizard? A Jade Lizard, look it up on Tasty Trade. I'm not doing a Jade Lizard here because I personally hate Jade Lizards. I like to do what I call a poor man's Jade Lizard. So a Jade Lizard is basically where you sell an at-the-money put. You sell kind of at-the-money, a couple deltas above call, and you buy a call above that. I'm making it a poor man for margin requirements because most of us don't have like $400,000 in our account. God bless you if you do. I don't like using all that margin, and I'm just a wimp. I don't like undefined risk trades, just kind of how I've stayed in the game through the years. because I don't do undefined risk a lot of times. And so I make it a poor man's Jade Lizard by buying that put at the bottom, that 1 delta put. If you can see that. And this is 65 days out. This is a long, or the closest contract to 65 days out. So I'm selling the 42 delta put. I'm selling the 50 delta call. Sorry, I switched those. And buying a 48 delta, and I'm buying a put way far out. So how this would look on a graph basically is think of like kind of like a strangle straddle setup. But why are you doing this? Well, the goal of this is, I went farther out for this, Stephen. You could definitely test at 45 days out as well, but just testing some different strategies for this year. That's exactly right. So you're using an extended time frame for this, and basically how this works is the way you're selling premium, it can afford to go down a little bit before you're lost. You have a capped profit, a smaller capped profit if it goes above that long call. If it stays within the range of the shorts, the tent of that's kind of max profit, and then you would lose if it goes down. Again, why would you do this? Well, I would not do this with a VIX above 20. So, as always, this is not a trade for VIX above 20. But for VIX below 20, what it is kind of, especially making a poor man, to some degree, it's a set it and forget it. I would never set anything and forget anything with options. But if it's kind of that type of trade. So you put it on, and you don't need the market to do anything. You in theory, what you kind of want is it to do just what it's done this year, which is just kind of stay put, largely stay put. Does that make sense? So it's a trade where you're going farther out in time, and you're just letting it breathe. You're just letting it sit there. If we rally 200 points, that's fine. Who cares? You'll make some profit. As long as we don't have a massive drop, which again, theoretically, using a stop of a VIX 20 should help with that. Just get out then. But, I like this trade just because it's like I said, for a vol environment where it's not doing anything, you go farther out in time, you don't really care what happens today or tomorrow. You just don't want VIX to give above 20. Any questions about that? You can look it up. Tasty Trade kind of made this famous, so you can look up their stuff on it. They do it a bunch of different ways, and they do it a lot on equities. But you can definitely do it on SPX if your margin's enough, especially making a poor man's Jade. Any questions about that one? Okay, let's keep going. Trojan swap. Again, this is one of my favorites I like to do in pre-COVID environment. I'm going to send the link. Let me know when you guys have that up. Cool. So what we're doing here is we're selling the 50 delta call and the 50 delta put. Now this is a 1-2. This is a 1-2. So I want you to, this is the shortest term trade we'll do here. It's a 1-2. You're selling basically the straddle, the one-day straddle, and you're buying call and put of different variations 2 days out. So this is skewed towards the upside, skewed in favor of the upside, with that being 75-point long and then the 100-point long on the put. And again, what is this? It's an environment where we're saying, I don't think it's going to go down a lot. It might stay put, or it might go up a little bit. But you're giving yourself, the difference between this and like an iron fly, a really wide iron fly, is on those longs, you're giving yourself a little bit of Vega. You're giving yourself like a little bit of Vega with that 2-day, not much. But you're a little more protected with some Vega risks than before. I'm not going to spend too much time on that, but think of this as like a butterfly, but the longs are farther out. I made the name Trojan swap. I don't know why, but I did that like 4 years ago. And Rusty'd be like, "What are you putting on?" I'm like, "Just my Trojan swaps." And he's like, "Well, I don't know what the hell that means." And I'd be like, "Well, cool. You do you, bro." And then we'd laugh. Any questions about that one? Again, why are we doing that? Don't do it above 20. You're just kind of wanting extra Vega protection, while still collecting being positive theta. Those are kind of the names of the game with the low VIX environment. Let's keep going. Okay. This one's interesting. This is a rolling put spread. Let me know when you get it. Cool beans. So, what you're doing here, 45 days out, you're selling a 25 delta, buying the long 25 points below that. You put it on every day. You're allocating 20% of the portfolio. You have a 50%. This is actually a pretty kind of tasty trade method. 45-day, roll at 21. Take 50% profit or exit the trade at 21 days. I would also add again, get out at a VIX of 20. You want to exit when it gets within 25 points of your strike. And we've got the Punisher, and pay attention to this one. We're rolling this, meaning we're re-entering the trade after the exit. So if we exit with 50% profit, or we exit for the slip it, or for the put is tested, we're putting it on again. You could definitely try this with a condor, like putting these in a portfolio. Try this with a call side too. I will tell you that if you do it in 2017, you're going to get wrecked because we just went up all year. But you could try different time frames and go from there. But again, it just kind of wins. It's one of those. It's a high probability trade. You have ways to get out, and so you're just kind of putting them on every day. One thing you'll notice about this: none of these are like 4,000 cagers. None of these are 4,000 MAR ratios. These are just kind of like one of the things you have to take into consideration when VIX is low is that you're not having as many opportunities to just make 50% a trade every day, or 20% every day. So the compounding slows down a little bit through time, and that's okay. It's about survivability. Any questions about that rolling put spread? Okay, I just put three tests in there. These are the final ones, and we won't look at all of them. But I'll look at QQQ just because it's cute. It's the cutest out of all of them. Because I don't know if you know this, but NASDAQ's done pretty well the last 10 years. So let's look at the QQQ one together. So it's the same metrics for all of them. But again, have you guys ever traded covered calls? That's kind of like the first thing people learn about options is a covered call. Covered call being something like you have 100 shares of SPY, you sell a call against it, so you're collecting premium. Well, this is a poor man's covered call. We don't have 100 shares, but we're gonna through parity try to make that. So what we're gonna do is we're going to buy a 365-day out 50 delta call, and we're going to sell a 60-day out, call that's $5 above that. Again, these are equities, so you got to remember that's like 50 points. And we're not, there's a couple different caveats. Again, I wouldn't do this on a VIX of 20, and you probably could make this a little bit more discretionary. So you could roll the calls. You could keep that 365 all year and just keep rolling, selling the call against it, the 60-day. Do that 4 or 5 times a year. But for the sake of the mechanical one, just looking at it, this is just a set it and forget it. We're just buying these, and this is actually 2013 to 2017, a lower VIX environment. And as always, like I said, you get out when VIX is 20, but otherwise, what are we doing here? What we're doing here is your 60-day is going to be collecting a lot of theta. And so the theory on these is that you're getting paid to be long to a certain degree. You have less carry risk because you're getting paid to be long. Now, of course, if you drop, looking at those legs, you're going to get hurt. But again, with a stop loss of 20, I feel like that's a pretty good trade in an environment where, we're not doing a lot of movement this year. We're not really going so. And again, tomorrow we could drop 800 points. I don't know, or go up 800 points. But looking at the environment so far, where VIX is kind of slowly receding, this feels pretty good because you're kind of getting paid for some of that Vega going down on the shorter term DTE short call. But you have some positive Vega with being a 50 delta call as well, 365 out. Again, these aren't my favorite type of trades. On the short 50, see, it's tough, because I don't have my brokerage open, but you could look what 5 points ahead in QQQ would be 50 points. 60 days out. I'd be guessing off the top of my head, but you could definitely rerun this using Delta instead of the 5 points ahead if you wanted to even get it more mechanical. But again, these aren't my favorite type of trades, but what this does is you're kind of getting paid for it to slowly go up, right? This is what you're doing. And just to finish this little session off today, I'll show you something that's interesting about that from this year. So this is year to date on SPY, if you can see that. Actually, the SPY one is year to date. So if you see that. And again, you're just kind of like sitting there through time. You only have 6 of them long, but you're just kind of sitting there. Positive 8% ORI. It's just kind of there. So again, these are the takeaways for today. My takeaways for today are: if you're worried about vol getting crushed, if you have not traded much in a low vol environment, the takeaways are: you want to think of VIX environments in 2 ways. A VIX below 20 are these types of trades. You go farther out in time, you re-equilibrate the Greeks in your favor. So you want to be positive theta. You want to have less gamma risk, remove some of the gamma risk, because markets can move really fast sometimes when they break out of these environments. So you want to remove some of the gamma risks. And in exchange for that, you're accepting that you're probably not going to have a high ROI as you would, or CAGR as you would, or MAR as you would in a really high VIX environment. So one kind of heuristic you could think about it is, if VIX is at 80, you want to sell very, very short-term options, because the crush they can just get decimated on any move down, and it has to have so much movement to keep that going. Sweet Almond, thanks for looking that up. So you want to go short term, higher VIX is. Longer term, a low VIX environment, you have to flip that. You want to go long term because you want to be long Vega. It's just kind of that equilibrium of the sea of options. Greeks short when Vega's low, when IV's low, go long dated. When IV's high, go short dated. That will keep you. That has the ability to keep you in the game, keep you safe. And the trade-off is ROI. It's not like as many generational opportunities, although I will say, we'll do this, who knows, in 3 months if VIX is at 10. VIX at 10, there are some generational opportunities, but we'll look at those if VIX gets back to 10. So, any questions about that? I hope that helped at all. If anything, just option make is good for idea generation. So if you feel stuck, if you feel like nothing's working that worked 6 months ago, A, you're not alone. B, you're right. C, there's lots of other opportunities. So you gotta shift that mindset. It's like the Warriors Lakers. I'm a big LeBron fan, and the Warriors have been trying something different every game. You just got to keep doing what you got to do, keep adjusting. So, any other questions? 30-day pre-equilibrium. Thank you. 30 delta is the same. Yeah, you could test these. Definitely take these, make them better. They're not optimized. I always say that. I do not optimize Cigar Lounge tests. That's for you guys to do for your homework, but hopefully it just gives you some ideas. So, with that being said, I'm going to let you guys go. We'll be doing some more Cigar Lounges shortly. And you guys are awesome. Appreciate all your support, and we'll go from there. So have a good rest of your day.